Greetings, I'm Andrew Ludwig, and welcome to BLACK ONYX Alternative Investments, where we bring you face-to-face with South Africa's most talented boutique asset managers and industry stakeholders. Why do we do this? We believe that you, the investor, deserve to be better informed so as to achieve better risk-adjusted returns. In this interview, I'll introduce you to Andrew Koch from Florin Capital Management. He runs the Florin IDS Vinci Retail Hedge Fund, which was established in 2005. Andrew, thank you very much for joining us today. Can you please tell us a little bit about yourself and how you got into the alternatives industry?
I started out as a financial analyst for one of the international brokers, and I used to present to Hedge, which is a listed hedge fund at the time, part of the Coronation stable. And when they delisted Hedge and brought it in-house at Coronation Capital, they offered me a job to come and join the team. So that's how I started. My partner, Fred Bouchard, who started the business with, he used to run in a long-short strategy for an enhanced index fund for one of the life insurance companies, and that was his start into alternatives.
Andrew, tell us about Florin Capital Management, a bit about the firm, a bit about the funds that you represent.
Florin was formed in 2010 after Fred and I had worked together for a number of years. We initially formed Florin to focus on hedge funds, but we subsequently branched out to offer a Reg 28 balance fund and offshore model portfolios for people that want to externalize money. Our focus is on value investing, and we have an absolute return focus, and this feeds through to all our funds. We've got a small team of investment professionals, and we outsource everything that's not core to the business. So most of the administration is outsourced, compliance, and all the other functions that we need to comply with. So we focus purely on investment management here.
Andrew, give us your definition of a hedge fund. Can you explain to us what exactly short selling is? And what's the importance of liquidity?
Our definition of a hedge fund is an absolute return strategy that focuses on managing the downside through short selling. Short selling is selling something that you don't own. How you do that? You borrow it from someone else and you sell it with the expectation of buying it back for less in the future and hence realizing a profit. Liquidity is very important, as you never want to enter a position that you couldn't get out of. The only time we would consider entering into a liquid position is where there was a corporate opportunity which would unlock the liquid position.
How exactly is your fund different from other alternative investments and mainstream products that are out there?
The Vinci hedge fund runs 4 underlying strategies: South African equities, offshore equities, commodities, and fixed income, including convertibles. The South African equity part of the fund, we run long where we find undervalued shares, and on the short side, we short overvalued shares, or we engage in what you call a relative value trade. A relative value trade is, let's use the banks for example, where one bank is significantly more expensive than another bank, but the outlook is pretty similar, and we think over time the valuations are going to converge. We would be long the one we think is undervalued and short the one that we think is overvalued, and as the two prices converge, we end up with a profit. The offshore exposure is generally related to corporate opportunities and restructurings where we get involved in rights issues, where there are capital structures or bonds that are being restructured, refinanced, and we have opportunities to buy securities cheaply and unlock essentially absolute returns. Commodities are related sometimes to our long positions or other times just to our views on currencies generally, We love convertible bonds. There aren't enough of them in South Africa, but they're great instruments where you own the convertible, you earn a coupon in the interim, and if their position ends up the way you thought about it, you end up essentially with an equity-like return, but with the backstop of a bond-like return in the short term. After the financial crisis, there were a lot of companies in Europe, particularly property companies, that had a lot of debt in different tranches, and investors had given up and the debt was trading very cheaply. What we need to do was we had to do our work. We had to establish which tranches, the ranking of the tranches, the assets backing each tranche. And then after we'd done that, we could go in and try and find the tranches that were most attractive. It was a very low-risk trade as there were significant assets. Often the assets were overvalued, so you needed to adjust them down to market-type values or where the market was at the time. If you still had sufficient asset backing and you could buy these securities yielding about 20% in euros, so sort of on a 5-year term, we found that very attractive and we bought them. That's one example. Other examples are where you've had essentially corporate unbundlings also often out of favor, where people have given up, they've got bad track records, but again, very much asset-backed, where you need to engage with management, and they end up unbundling or spinning off assets, and that way you unlock the discount, and you can make very attractive risk-adjusted returns.
Thank you, Andrew, for sharing the detail that you did on how you got into the industry and about Florin Capital Management. And thank you for tuning into Black Onyx.